Hey, good morning, everybody. Welcome and thank you for coming. I've got Greg here. Greg, how you doing, buddy?
I'm great. How are you, Ben?
Excellent, excellent. Just kind of feeling the holiday hangover. Took a lot of last week off, and now I'm playing catch up. Do you have a good one?
Oh, I had a really good Thanksgiving. Ate too much as usual.
Yep, for sure. Well, thanks everybody for attending. So, Greg, I know I see Evergrande pulled up. What do you got for us today? Morning, Neil.
Okay, good morning, everybody. Yeah, I like to start with Evergrande just as a reminder that that's going on. There's no real new news that's really critical, about that right now, but that's going to probably blow up next year in China, and we'll see how that plays out. But this is just a reminder to be aware of that and keep an eye on that. Okay, so I'll like to start there. Now, my purpose in this show is to teach you new things, and one thing I want to teach everyone is sources of good information that you can rely on. One of the hardest things that I went through personally 20, 25 years ago when I was trying to understand the stock market is to figure out who you could believe and who you could trust, because it's hard to know who really knows their stuff and who doesn't. Okay, so one of the things I'm going to do today is introduce you to someone who really knows the stock market, and that would be Gary Caltbaum. I'd never heard of this guy until maybe 4, 5, 6 months ago, something like that. This guy has a nationally syndicated radio show called Investor's Edge, and I really like it. He gives really good information about what's going on behind the scenes in the marketplace. Okay, this is a national show, and so you should be able to catch it on the radio wherever you are in the United States. It comes on at 6 o'clock Eastern time on weeknights, most weeknights. Not every night, but it seems to be a little bit hit and miss, but it's often, and it's on the Money Talk Radio Network if you can find that. Anyway, if you don't want to catch it on the radio, you can catch him online. You can just Google his name, and I've even seen him advertise his radio show on his Twitter page. So you could go there and listen to the show. Really good information. This guy isn't just a radio commentator, he's a money manager. I think he's a registered investment advisor because he manages, wealthy individuals' money. Uh, he does get a little bit political. He blasts Republicans and Democrats, which I really like about him. I'm pretty sure he's Republican, but he calls everybody on the carpet for the stuff that they're doing, the politicians. So I really like this guy. I listen to him all the time. So I would highly invite you to listen to his show, listen to what's going on behind the scenes, and I think you'll really like him. You can trust what he has to say. All right.
I'm actually familiar with that show, and Gary, and you're right. It is he definitely knows his stuff.
How long have you known about this guy?
Man, I actually haven't even thought about it for a while because I just don't listen to a lot of podcasts or anything. But it was over a couple years ago. We had a mutual was that Investor's Edge, or not Investor's Edge, one of the conferences that Steve was doing.
Mm-hmm.
He was involved with, and it just somebody introduced us to us at that point. So it's been a while, but I remember he was very smart, very savvy.
Yeah, he really knows his stuff in the markets. You listen to a lot of commentators and talking heads on CNBC, and I can tell from being involved in the markets for a long time who knows their stuff and who doesn't. There's some people who come on CNBC that I do not respect at all in their opinions. But I just found out about Gary 6 months ago. Neil says he's been around for years. I would suspect so. It's just that I had never heard of him before. But he's really good. I'd invite you to listen to him. Okay. And one of the things that I love that he does is he mentions what the politicians are saying versus what they're actually doing behind the scenes. So he calls them on the carpet. He catches them. I love that.
Very cool.
Okay, this is the biggest deal for the market right now. The Fed chairman, Jerome Powell, said that they're going to speed up tapering. Tapering means that they're going to lower the amount of stimulus, like going from $100 billion in bond buying per month to 90 billion or 80 billion. Because of inflation, there's now political pressure to stop inflation. But if they stop the stimulus or if they stop it too fast, we're going to have a bear market. You got to think of it kind of like blowing up a balloon as big as you possibly can. If you don't keep the pressure up on the balloon, it's going to get smaller really fast compared to blowing up the balloon at the start where there's just a little pressure. That's kind of an analogy on where we're at. The balloon is at full capacity right now. We have more leverage in the market now than in 2008. Did you know that? We have more debt and higher prices than before the crash in 2008. That puts us at a very risky potential spot as far as if a bear market comes, it could be pretty big. Okay, the market fell in 2008. The market fell 55%. It could fall that much again. So we still, we don't know when that's going to happen. We don't want to suddenly go short big, but we don't know what's going on right now in the markets. If they taper too fast, if they lower the stimulus too fast, if they raise interest rates too quickly, it's going to cause a bear market. Okay, I'm telling you that right now. I've been studying the markets for 30 years and the cycles of the markets and the signals of what starts and stops bull markets. And so I know what I'm talking about here. Okay. So let's look at the case of the bullish versus the bearish for just a second. I don't see a lot of, case for bullish for the market going up much higher. I'm not saying we're at the end of the bull market right now. I don't know. Nobody knows. But I don't see what's going to drive things much higher from here. On the evidence for the bearish outlook, we've got the Fed tightening. We've got the whole China situation. We've got inflation. We've got supply chain issues. And COVID is not over yet. There's a new variant that just came out they're calling Omicron, if I'm saying that right. They don't know much about it yet. They're studying it. I'm sure we'll hear about it in the coming weeks. But these things are spooking the market a little bit right now. Again, don't know how this is going to play out, but we gotta be careful. We gotta watch the trend closely, and it might be a great opportunity to be buying puts or selling short because we don't know if it's going to follow through yet. Okay. Now today in the market, we're getting a little bit of a bounce. Let me go to the, okay. Hold on a second. I'm not sure that's showing most current. Let me fix this. Hold on. Okay, here we go.
There you go.
There we go. Now we got a current update. Okay, so the market was down hard yesterday. We've got a little bit of a gap, and we're up a little bit today. I'm not impressed with this just yet. This is not signaling a new uptrend yet. This is just a bounce. And I think we're still going to have more downtrend. But if we trend up from here, then I'll be convinced. So at least several more days before I'd be convinced that the downtrend is over. Okay, now what we want to do is we want to measure the bounce. We want to see really the stock. If we're in a bull market, the stock will trend up, or the whole market rather will trend up at least to previous highs, if not higher. That would be normal, just a steady, trend, just like we saw on this same chart a couple months ago. It was down low in October, and it trended steadily for about a month or so. to new highs. So that's what I would expect to see again if we're still in a bull market. If not, then what we'll see is a bounce that might go up to say 356 on DIA, which is the tradable symbol for the Dow. And then it'll start to roll over and come back down again. So we might be entering the bounce phase. I'm going to watch closely how high it bounces. Okay, now let's look at some of the stocks that I'm looking at right now. These are stocks that, these next three stocks are stocks that I pulled up on a scanner where the PE ratio for all of these was over 500. That's insane. That's super expensive. The first one, which I actually issued a debit spread to put on it, is Alaska Airlines. This is an airline. It's not even a tech stock, and it's over 500 on a PE ratio. Normally, it should be about 20 or 25, and it's at over 500. That's insane. So I would tell you that this is extremely overpriced, and it looks like it's might be going down steadily for a while to come. I want to show you a long-term chart on this, so hold on one second. This is that was the 4-month chart. Now here's the year and 4-month chart. So it's been off the highs for several months, even though the market was at highs just a few weeks ago. So if you look at this, you see that this easily could drop all the way down to the next support level around 30. So it's got lots of room. It could fall from here. We're going to see if it can even fill the gap back up to 52. I have my doubts, but I'm a little pessimistic at the moment, as you can tell. So that's my attitude on life. Here's the thing, though. For the last like 5 years, anytime the market has started to sell off, the Fed has jumped in and pumped more money into the economy. This time, I don't think they can do that, or else they're going to get more inflation, and that's going to be really bad politically. So the Biden administration is in a tight spot right now on how they handle this. They're going to try to, meet it in the middle and not rock the market, but at the same time stop inflation. I don't think it's possible, personally, but we'll see. So that's one stock with a super high PE ratio, lots of room to fall. Let's look at another one, also with a super high PE ratio. This is Royal Caribbean Cruise Lines. Excuse me. Now, you know that the cruise lines got creamed during the pandemic. People could not, go on cruises, or else they could get sick, right? But this stock has bounced back up with the vaccinations that came out. So let's go to a longer term chart on this one as well. Take a look. Okay, so you can see it over the past year. It started to improve, and it was at a low of 51 within the past year, and it was as high as 98, actually 99 back in February. It came close to that just recently, last month. Let's see, no, earlier this month. And you can see it's come back down. We're at a major support level. It might bounce from here and go back up, or it could go down from here. But the thing is, this also has a PE ratio of over 500, or at least it did a few days ago when I did the scan. So this is way overpriced. I just don't think it should be up here, especially if another COVID variant really kicks into gear. This is going to get creamed again. So we'll keep an eye on that. Another one, my third stock with a super high PE ratio over 500 is Hilton Hotels. So Hilton Hotels is a much better looking chart. It's closer to the highs than the others, but it just gapped down a few days ago. with the rest of the market. Let's get a closer look on this. Okay, this is what it's done recently. Now you can see it's up 2% today. It's up $3.17 at the moment. So it's okay at the moment. It didn't, gap down too hard. It's come back. Actually, it did gap down pretty hard. Let's see, it went from about 144 to about 136, about an $8 gap. But it's higher than that. It's starting to fill the gap. So this is a better looking chart, but still, I don't understand, unless the scan is wrong or something. It's got a PE ratio over 500. It's a hotel. The PE ratio on something like this should be 20, or if it's really expensive, 25 or 30, not 500. So I really don't understand what the deal is on this. Let me see if the PE ratio is shown on here in the top left corner. I'm looking up here. Oh my gosh. You see what it says there right there? PE ratio, according to stock charts, it's over 1,000. There is no way it's worth that. It's a hotel. Unless it was a brand new hotel growing super fast, it simply is not worth that. This is a pretty good sign. This is a stock that's in a huge bubble, and it's going to get creamed whenever the market comes back down. Okay. One of the ways that I use to find great stocks for trading is stocks that recently came out with earnings, especially if there's a big earnings surprise. Now, there's a lot of stocks on here I'm not familiar with. A lot of them are small stocks, not trade, 1 million shares a day, which is what I like to trade, stocks with at least that much volume. But here are 3 stocks that I know right here: Salesforce, Zscaler, and NetApp. All 3 of them came out with earnings in the last couple of days. Let's take a look at them. Okay. So first, let's go to Salesforce and see what it's doing. Ooh, okay. Salesforce announced 38% increase in earnings. Apparently, the market didn't like that. Again, I've said this before, it's not the news. You would think that the stock would go up on 38% increase in earnings, right? That's great, a great number. But it's how the market reacts to the news. You got to do whatever the market, says to do, not just follow the news, follow what the market does in reaction to the news. Okay. So this is a stock I'm going to watch. I'm going to see if it starts to trend up or down. And then I might put on a position for that, because it might continue to trend just like our Disney trade did. It trended down, and we scored real good buying a put on Disney. Let's look at the other one, NetApp. NetApp said that they made 5% increase in earnings. Stock is down a bit today. Not too bad. I don't see a big change in the trend going on here, so not as interesting as Salesforce. Let's look at Zscaler. I've got a few stocks that I'm looking at, but if you have some, feel free to put them in the comment section and I'll take a look at it for you. Okay, let's take a look. Zscaler announced a 16% increase in earnings, and they gapped it up and sold it off today, it looks like. So now we're down to about the close of yesterday. Again, not a huge change, but this is a stock that has been trending up really well. I don't know. I don't see anything super interesting about this yet, but I'll keep watching it. So far of those 3, what you want to look for is a really unexpected increase or decrease in earnings, because then the stock is more out of price from where it should be, and it's likely to trend a big move and start to trend up or down from there. So when there's a big surprise in whatever they announced for earnings compared to what they thought was going to be announced. Okay, so that's what I'm looking at. And so far, CRM has the biggest surprise and the biggest reaction to the in the stock. So that's what I'm looking at. Let's look at another one. Hewlett Packard. Haven't looked at this one in a while. Hewlett Packard just announced earnings and the stock is down. Okay, it gapped down and it's going up a little bit today, if you can see it right there. That's what's going on. Another one is worth watching, but I don't see anything amazing going on here that I want to necessarily catch a trend on. I don't see it trending yet. If it starts to trend down from here, maybe I'll jump on, or up. I might jump on, but I'm not convinced either way at this point, to be honest with you. Let's see here. Roy Sykes says, I fear the Biden administration doesn't know what it wants to do. They're in a tough spot right now. Absolutely. MIME, John Sherlock. MIME, let's take a look at that. MIME. Mimecast. Okay, I don't know when they announced earnings, but this has been a real nice uptrend here. And as the market has sold off in recent weeks, this thing hasn't sold off. So this is a very strong stock. The PE ratio, if you look in the top left corner here, is at 116. That's very high, but it's quite reasonable compared to the rest of the market, compared to a 500, PE or 1,000 PE ratio. So this is looking very strong. I'm not too familiar with this stock, but I would suspect this is probably a growth stock in a smaller company with a chart like that, from 50 to 80 in just a few. Yeah, this thing's growing fast. This has a lot of upside potential. If the market doesn't continue to sell off from here, this looks like a great stock. I'm going to look into this one. I like it. Thank you for bringing it up. Going to look at MIME. It's very strong. If the market starts to go back up, I would suspect this stock to go up because it's showing lots of relative strength. If the stock does not go down while the rest of the market is going down pretty hard, just like this stock, then you got a good stock that's probably going to go up real strong if the market levels out or goes up. That's relative strength. So this is a really good one. I like it. On the other hand, if the market sells off really hard, we're talking for the next year or two or the next month or two, it's going to take everything with it. So if the market goes down, say another 10% over the next, 2 months, most stocks will go down with it. Some stocks, like this one, will try to hold its value, but they won't go up. They'll go down. They just won't go down as much as other stocks, or maybe as much as the market goes down. So this is a good stock. I like it. I'm going to keep an eye on this one. Very nice. Okay. You have any other stocks you want me to take a look at? Otherwise, I'm just going to poke around and see what I can.
How about current trades that we're in, Greg?
Okay, sure. Let's look at the Disney trade. We just scored on Disney. We did really good on it. Okay. Now, we actually did a debit spread on Disney, a put spread, which means that right here, the day after the gap down, can you see my pointer, my crosshairs?
Yeah.
Okay, if you can, that's the day right there that you want to enter the trade, the short trade, whether you're selling short or buying puts or selling calls. Why is that? Because after the gap down, we're seeing that Disney is looking like it's going to trend down from there. That's the day where it shows you it's going to trend down. Right there on the previous day, it closed at that price right there. On this day, they gapped it up and sold it off. And so right about here is where I want to sell, because it's proving to me that it might trend down further from there. If you see the stock going sideways or going up, you don't want to enter a short position. You want to watch it and maybe maybe buy it if we think it's going to fill the gap. But that's where it's showing that it's going to trend down. If not that day, the following day at the very least, because it's showing more new lows compared to the previous day and more sell-offs. So this was an easy trade to jump on. Because of all the commentary on Disney and because it was already in a downtrend, I was thinking about issuing the debit put spread a couple days before earnings, right up here. But that's a risky proposition. I don't like doing that. And I'm not going to make an alert like that over earnings because it could have just as easily gapped up compared to gapping down. Okay, so I don't like to do that. But the second day after the gap, clearly it's a good potential stock that's going to trend down. We sold the 155, or excuse me, we bought the 155 put, I think it was. And then we bought the 155 put, and then we sold the 145 puts. So yesterday, when the stock was below 145, I issued an exit alert saying, this is max profit, get out. There's no reason to stay in. Ring the cash register at max profit. Now, it's bounced up today for one day. I'm not convinced that this is a new uptrend. I still think there's plenty of room to go down, but I hope you already got out for those of you who are in the trade at a max profit. Could you tell us the date to open the spread? Sure. Okay, so you guys out there can't see my pointer. Okay. So on the chart, you can see the day it gapped down on really big volume. That's the day where the volume, the bar below the charts, that's volume. The highest volume day, that's also the gap down day. They call it a gap because there's a big space between the opening price of that chart and the previous day. Okay. On that previous day, it was at 176.87. It gapped down, and then the number on that candle is 158.33 below it, if you can see that. The day after that, or the second day after that, that's confirmation of the downtrend. Sometimes stocks gap down too far and then they trend up and fill the gap. Well, within a couple of days, it's pretty clear that wasn't going to happen here. So, it always could, right? You never know what's going to happen. But it's a pretty good, and it's a safe entry point. Okay, it's a pretty good entry point. So let's say that I entered this trade at about 161 or 162 short, whatever way I did it, by selling short the stock or doing the put. If it starts to trend above the candle of the gap or the day after, that's when it's proving to me I'm wrong and I need to get out. Okay, because it shouldn't be going up there if it's going to trend down. Instead, it did exactly what I thought it would and hoped it would. And it's been going down, straight down for 2 weeks, basically. Okay, so we scored real good. On this trade, it cost, we went out to December 17th for expiration. And the debit, the cost of doing this trade was $200. And if you got out yesterday, you were able to sell it for around $700 for a $500 profit. That's the power of options when the stock really goes in your direction. Okay, so this was a really good trade. Now we've got this same trade going on with Alaska Airlines, basically the same type of trade. So let's go back to that, ALK. Okay, so it looked like yesterday that it was going to go the downtrend, but we bounced up. So right now it looks like it's going sideways. I don't hold on to these. When I do a debit spread, I don't hold on to these or buy a put. If it doesn't start to move in my direction within a week or two, I'm out. I'll take a small loss and I'm out. So for example, if it cost me $200 to get into this trade on a put, then if it doesn't do what I want to do, I'm going to lose $50 or $100 and just get out. Okay, I'm not going to just hold on forever and hope it actually trends down. And certainly if it trends in the wrong direction, I'm going to get out and take a small loss. That happens. Small losses are okay in the markets when you're trading. It's inevitable. Large losses are not. You don't have to hold on and just hope and The stock doesn't move in your direction, and then you lose all $200 when you're buying a put. Okay, and Frank says, how do you determine a credit versus a debit spread on the stock? That's a great question. That's actually a question we're going to cover in more depth in the workshop that I'm going to do. All right. So on this particular trade or on the Disney trade, what I would do, if you think that a stock is really going to run to the downside, I want to buy a put or do a put debit spread, which is essentially buying a put and then making it cheaper by selling a put further away, further below. It's pretty simple. It's pretty straightforward. Okay. So if you think the stock is going to run, which they often do to the downside in the current market environment, I want to buy puts. If I really think it's going to run down, I'll just buy a put outright and not even, I'll buy the put outright and not sell the lower put, because if it really runs, that's going to limit your profits. Like it might do that in Disney if it trends down further from here. Okay. So if you want to just more of a conservative, steady income, higher profit, higher odds of success trade, you do a credit spread. It's a more conservative strategy. Lower risk, lower reward. The setup is really the same though. If, let's say on this trade on Alaska Airlines, right now it's going sideways. I probably would have sold, sold a call around 51, 51.50, 52, somewhere up there. Because if it starts to trend up there, I'd probably want to do it about 52 to be conservative, give it plenty of room. But if I did a credit spread on that and it starts to trend up there, it's proving me wrong. It's proving to me it's going up where I didn't think it was going to go. And that's when I get out and I take whatever, losses I have to, and I just get out. I don't take the max loss. We don't need to do that. Okay. So that's how you do it, whether it's a debit spread or a credit spread. I said that pretty quickly. You might have to review the video recording that we send out and put on YouTube, but that's how we do it. So if, I'm not concerned if Alaska Airlines goes up to 51 and then comes right back down. I'd really like to see it trend down right from here because it was lower yesterday. But if it does start to trend and hold its value above 51, I'm out. That's proving me I'm wrong. It's not looking right. I thought it was going to go down. It's not doing that. I'm out. You take your hit, small hit, move on to the next trade. I lose 50 or $100 on this trade. I make 200 or 300 or 400 on the next trade. That's kind of how it works for a debit spread anyway. For a credit spread, you might lose 100 on this trade. You make 100 on the next 2 or 3 trades, something like that. Delta Airlines, let's take a look at that. The airlines are really dependent on what happens with this new, COVID strain. If the strain turns out to be bad, then everything that got hit last year is going to get hit again. Movie theaters, airlines, retail, anything where people congregate together is going to take a hit. Now, looks like Delta Airlines went down. I don't know if that's with the market or if that's an earnings announcement, but it did gap down a few trading days ago. Right now it's sideways. It's at the gap. I don't see a trend up or down yet. So it's worth watching, but I don't want to enter a position on this up or down at the moment. If you think, I want to watch a little longer because it's gone up, but if you think right now that it's not going to go up above the gap price of 37.50, then you could probably sell a call at 38 or 38.50, depending on how much money you could get out of the trade. And then for protection, you buy the higher call around 39.40, something like that. So okay, let's see here. When did you say you get out when doing a put spread? So regardless of how I trade it, what security I'm using. If I'm doing a debit spread, a put spread, or selling a call spread, whatever. What if my idea, and I'm betting on the fact that in this stock that it's going to trend down from here, where does it prove me that I'm wrong? If it starts to trend up above previous resistance level, which is currently at 37.50 or so, 37.25, approximate area. If it holds its value up there, I'm wrong. It's not trending down. It's sideways or up. So it's proving me wrong, and I want to get out of whatever way I did the trade. Okay. Okay. So if I did a credit spread, as long as it doesn't go up, we're good. We make money. So we could be okay with that. But if I bought a put or sold short the stock, if it's not going down like I thought it would, if it's going sideways or starting to go up above resistance, it's proving me wrong. I got to get out. And right now, the resistance level where it's held at since a couple of days ago is 37.35 is the exact price. Resistance is a general price. So 2 days ago, it bounced off that price, and it went, even though we gapped up today, it went up near that price, came back down. Okay, so as long as it doesn't go above that on a credit spread, we're okay. If I sold short the stock, or if I say bought a put yesterday, I want to see it come down pretty fast, or I'm out. Okay, I don't want to see it up here for very long. It needs to trend back down pretty darn quick, or else I'm out. Take my loss. You don't want to let a small loss turn into a big loss. So when it starts to trend in the wrong direction, get out quick. That's how it works. Let me get caught up with the questions here. So Roy, on down stock, the difference between selling a call spread or buying a put spread is your conviction in the trend direction. Yeah, absolutely. Not just my conviction in the direction, but if I buy a put, do I really think it's going to keep going down? Or if I sell short the stock, do I think it's going to really keep going down from there? When a stock gaps down and starts to go down, there's a good chance that'll happen. But, if it doesn't happen, you're wrong, you get out. Simple. Take a small loss or break even and go on to the next trade. John, do you use Delta to choose strike price? Yes, I keep an eye on Delta, but Delta is almost always at 0.5 when you're doing an at the money trade, whether it's a call or a put. It's pretty close to 0.5. So when I'm doing a put spread, when I'm buying the spread, buying the option, I want it to be at the money or in the money. Or if I have to be out of the money just a little bit. If you're right, you want to make money fast on the trade. So you want to have a high delta, and you're going to do that at the money or in the money. Okay. A lot of people, the way they actually do trades with options is they put a small money down on a stock that's going out 3 weeks, and they hope it shoots to the moon within 3 weeks. Like, for example, on this stock that's currently trading at 36, they'll buy a 46 call. The odds of it going above 46 where you make money is almost zero in the next month. Okay, so it's like buying a lottery ticket. It's not likely to happen. If there was a way that I would do that type of trade, if the market falls fast like it might do, that's about the only time I'm going to want to buy a put option that's a little bit out of the money, 3 months out or something. So it has lots of time to do what I hope it will do. That's about the only way that I'm going to do it, because the odds of it expiring completely worthless are very high. Okay, so that's not a good strategy for a professional trader. All right. Jeremy, do you consider volatility when buying a call or a put? For example, I've read on Tasty Trade that they recommend buying calls in low implied volatility and selling calls in high implied volatility. Okay, that's a pretty technical question. That's probably more than I can answer right now in this short time period. That's not delta. Okay, that's implied volatility. That's different. Yes, there are strategies where you look at that. But Jeremy, I hope you bought the program, because we're going to talk about that a little bit. But that's very complicated, and anyway, I can't really answer that well right now. But just in general, yes, you want to sell high implied volatility because you get a higher price on the trade. However, there's also more risk on the trade, so you got to be careful with that. Generally, you're going to get that kind of trade on puts while the market is falling like it is right now. So you don't want to sell a put if the market's crashing. You could get creamed, right? Okay, so you got to be careful with that. Buying calls in low implied volatility, yes, in a very general way, that's true. But there's a lot of different things to look at when you make that decision. Okay, that's the hard part about options. There's a lot of moving parts. Okay, if you did, Jeremy, if you went to our webinar a few weeks ago and you paid the $297, then that purchases, that's the accelerator program. Then you did purchase the workshop, and we're going to be doing that pretty soon. Okay, if you're a part of that, then yes, you'll get that. Okay, unless there are any other stocks or any other questions, that's all I've got for today. So let's take a look. So this is your 30-second warning to ask a question if you have them. You're also always welcome to ask me a question, send to my email if you don't want to cover it here. Okay, you can reach me, Greg with 2 G's at thetradersplan.com, or options at thetradersplan.com. Both will get to me if you have any questions. Okay, so got a lot in that session. Thanks for being with us, and nice having you with us here today. Thanks for being here.
Thanks for all your info, Greg. All right, guys, email any questions, and we will see you next week.
Have a great week, you guys.